Hello and welcome to another episode of Darwin Investors. Today I'm going to talk about what I'm actually buying here early in 2022, but more importantly, I'm talking about why I'm buying it. And it's based on our certain economic conditions. The things that we have, we have the inflation data, we had the Fed taper, we have interest rate hikes. We have the Fed balance sheet being unwound, and a lot of these things they are concerning, right? Because it does make the market go down, but it's not the thing that concerns me most. So let's go ahead and dive into the inflation data first before we get to what actually concerns me the most and exactly why it is that the thing that actually concerns me the most, and we'll get into it. But let's go ahead and start off here with the inflation data. So right now we've got the inflation data was just released here on January 12th. It's a consumer price index by the Bureau of Labor Statistics. And what it shows is over the last 12 months, I'm sure you've heard that all items index increased 7% before seasonal adjustment. So basically there was 7% year-on-year inflation. Now this is a bit of a political football. Democrats say we can fix this, and Republicans say, oh, I told you this would happen. He's the worst. Let's get him out of here. But really, the truth is somewhere in between. If we look at this on a month-over-month basis, and we look at all items of inflation, we look from October until December, we can see that it's actually been declining for 3 months, and it's given us 7% year over year. The things that we're really concerned about, at least for myself, as I say, I'm concerned with food at home. I'm concerned with energy prices, gasoline, electricity, we'll say, utility services, shelter, and that sort of thing. And so when we look at food at home, we can see it's actually been deflecting down, from 1% down to 0.4%. So it's coming down. It looks like the last 4 months. Energy has come way down from like 4.8% to actually now it's negative 0.4% to where it was this time last year. Energy commodities, again, that's a negative from where it was this time last year. Gasoline negative where it was, fuel and oil negative where it was. So you can see that it's actually inflecting downward, and at least for all of our food and energy consumption type of things. Utilities have come way down from being 6.6% up year over year to down negative 1.2%. These are the reasons why the market actually really bounced on this news. When this data came out, it was like, you might have wondered why inflation was up to 7%, worst ever since 1982. The world is caving in. Oh no. And yet the market went up in a straight line on that day. Well, that's because of this. It's because everything's inflecting downward. Some of the things that hold up inflation and make it look pretty high would be basically that used cars and trucks were up. Indexes for household furnishings and operations were up. Apparel was up. New vehicles up. These are things a lot of us can actually don't have to buy if you don't. You don't necessarily need a new vehicle or new clothes or new furniture. But it's nice if it goes down. But if it doesn't go down, well, it's like, okay, I can wait. Medical care, actually, that increase, and that's something that can't wait. So these are things. So it's a mixed bag, but it's not that the whole world is falling. The whole world is catching on fire. When you look at the consumer price index for year on year, the way that they would calculate this would be that they would bring up a calculator and they would just take the December data from this year, which would be 280.192, and you divide it by the December data from last year, 261.560, 61.560, and you'll see that you got 7.12 is your rate of increase for inflation. Now, if you can see here, this is a pretty flat line. It's flat from like December through, say, January or February here, it looks like. So I would expect that inflation will either remain up or kind of flat from then, depending on how flat this line is on this side. But then it starts taking a rise straight upwards. And actually, this May to June rise is pretty significant. And so I would expect that when the July data comes out and it says for June, that it's going to show a significant decrease in inflation at that time if nothing was done at all. And that would explain why the Fed would expect the inflation to actually decrease. Now, this is minus food and energy and that, but they would expect the decrease to be 2.6 by the end of 2022, 2.3 by the end of 2023, and then 2.1 in the 2024. And how can they be so sure about this? Well, it's because they have this ability to raise interest rates, and raising interest rates seems to make inflation go down. So interest rates don't seem in and of themselves very high. They're high now, but let's say that if you can invest in, say, the S&P 500 versus interest rates, in the S&P 500 is generating, say, even 10% a year, why would you want a bond for 1.78? But then if you like back it up to, say, 5 years or even 10 years, you can, or even max, you can see that interest rates right now are way, way, way lower than they used to be. So if you can imagine that if bonds paid a 13.84% yield, you might think twice about investing in the stock market. But right now we're kind of at historic lows as interest rates are concerned. So equities are a very nice alternative to bonds at the moment. So the interest rates don't really bother me. Inflation doesn't really bother me, but there is one thing that really does scare me, and that's this right here. This is the personal savings rate of Americans right now. So if you look at personal savings rate, the personal savings as a percentage of disposable personal income, frequently referred to as the personal savings rate, is calculated as the ratio of personal savings to disposable personal income. So you can see that over the last 2 years, our personal savings rate was really high. And now it's back down to where it was, say, pre-pandemic levels. Because basically we had a lot of extra cash here. And a lot of this money was being pumped in the stock market, which is why a lot of our, say, price to earnings ratios and price of sales and all that went through the roof, and why we were able to make so much money the last couple of years. And if you actually back this out, say 5 years, let me see here, maybe 10 years, or even max, you can see that historically this was a real period of prosperity. So what does that mean? Well, a lot more people were investing in the stock market. A lot more people were buying more things, be it like anything on the internet, going out shopping. Basically our retailers were having a total golden age and the stock market to a golden age that unlike anything we've ever seen, at least not since 1960. So this is what scares me. So what I'm saying is that we're returning to a kind of more of a normal. It's not that it's like really low here now, but it's more normal of what we would expect over, say, the last 21 years. So what's the data that's coming out now? So the news that just come out today is that retail sales dropped 1.9% in December as higher prices caused consumers to curb spending. Retail sales declined 1.9% in December, much worse than the forecast for a 0.1% drop. Weak online sales were responsible for much of the slide, along with a fall in spending at bars and restaurants. Basically, we don't have the money that we had, say, a year ago. You know, there's not as much liquidity out there. There's not as much investing in the stock market. There's not as much as buying furniture and going on Amazon and going out to dinner. These things have all really decreased due to a decrease in our personal savings rates. Retail sales fell much more than expected in December as surging prices took a big bite out of spending. The Commerce Department reported Friday. Again, I don't know if it was so much that the high prices as it is the fact that we just don't have as much money. The advanced monthly sales report closed out to a year showed a decline of 1.9%, considerably worse than the Dow Jones. That's 0.1% drop. Excluding autos, sales fell 2.3% to a number that also fell well short of expectations, which was a 0.3% rise. So people haven't been accounting for this, and it's not been really spoken about in the media or anything like that. Online spending took the biggest hit as a share of overall spending, with non-store retailers reporting a plunge of 8.7% for the month. Furniture and home furnishing sales declined 5.5%, and sporting goods, music, and bookstores saw a 4.3% drop. So basically, we're really seeing a decrease in spending because honestly, we don't have the money. Restaurants and bars, which posted a 41.3% annual gain in 2021 to lead all categories, saw a decline of 0.8% for the month. Gas stations were a close second for the year with a 41% surge in sales, but saw a 0.7% decrease in December as fuel costs moved lower. Now, we talked about that in our CPI data. The gas prices just aren't as high now as they were a year ago. But anyway, not to belabor the point, but we don't have the money, and online sales and retail sales are just going down, and stock market is also going down. When you look at this right here, just come out today, JP Morgan shares fall as mixed outlook sours profit beat. Well, why are JP Morgan's? Now, they're half of a retail bank. That's the Chase part. But JP Morgan is your investment bank. It'd be like Goldman Sachs or Blackstone or something along those lines, Morgan Stanley, Merrill Lynch. So these are all things that, which I guess is part of Bank of America, but Merrill Lynch is part of Bank of America. But these are all part of their investment bank arm, and these are taking a hit. The bank reported a 14% drop in fourth quarter profit compared with a year ago, reflecting a decline in trading revenues. People aren't going in and trading. The previous year had benefited from increased trading activity as the Federal Reserve stimulus measures produced more liquidity in equity and fixed income markets. Now, all of it is not coming from retail traders, but dang it, 25% does. And if we are no longer buying because we no longer have the money and we don't have this disposable income, these banks are taking a beating, which is why I sold all my banks today. I had Wells Fargo and I had JP Morgan and Visa, which is not a bank, but I sold them all for a pretty nice gain. But I do see a slowdown in investing haunting some of these financials. The Fed began scaling back its asset purchases in November 2021, which we knew that about, resulting in lower trading volumes. We're talking about bonds here. Market revenues fell by 11% during the quarter. Fixed income market revenue was down 16%, with equity market revenue 2% lower. So again, market revenues are falling. There's a drop in the amount and people are investing that used to be. So these are all things that really concern me. And so when you take this in context, we got retail sales down, we got people investing less, we got less money in the market than we've had the last couple of years. These are the things that scare me. And then you look at something like this Purchasing Managers Index, which just come out in January. And the Purchasing Managers Index is a measure of the prevailing direction of economic trends in manufacturing. And the way they get this number is they are compiled basically the PMI is based on a monthly survey sent to senior executives at more than 400 companies in 19 industries, which are weighted by their contribution to the GDP. The PMI is based on 5 major survey areas: new orders, inventory levels, production, supply deliveries, and employment. And so when you look at the PMI data that was just released when was this? This was just released a few weeks ago from December of 2021 data, it said companies recorded the softest rise in new orders for a year. And longer lead times for inputs all led to another sharp increase in backlogs of work, albeit slowest in 10 months. Cost burdens continue to increase markedly despite the rate of inflation softening. We already talked about the inflation was softening to the slowest since June. Efforts to pass through greater cost to clients were hampered by softer demand conditions as charges rose at the slowest rate since April. So demand is coming down. And so there's not as need for as much supply. So I see bottleneck issues as being not as big a problem now as they were a year ago. We're not buying as much stuff as we were buying a year ago. And I understand inflation is a concern, and the interest rates are a concern, and the Fed taper is a concern, and unwinding a balance sheet is a concern. But for me personally, the biggest concern is actually the fact that there's not as much money, or at least not as much disposable income, to actually go in the stock market to keep some of these high price to earnings stocks going. And so I see a big time value compression coming towards this market. So with all this as a backdrop, what am I actually looking at buying for this year? Well, I had a plan, and I thought that earnings were going to bail me out, but sometimes things don't go quite like you hope that they would go. And so what I thought was I would be able to make it through earnings. Earnings would be blockbuster. I would then sell off on about the second week in February, but I've since had to change my plans. That's why I'm Darwin Investors. I can change my mind and evolve anytime I feel like it. I'm not this person to say, hey, go buy Workhorse stock at like $28. And when it goes down to like $19, I'm saying, I tell you, I'm right. Go ahead and buy Workhorse. No, sell. It's a loser. Don't do it. Just get out now. I'm already out. You should have followed. I would have followed me or something, or like watch a video. I would have told you get out. But like, so I expected to hold on to a lot of my stuff through the second week in February, and then I was going to tail out. But it turns out that these things are happening a lot quicker than I would have thought. So what am I buying now in 2022? Well, what am I doing? Well, first thing that I would suggest that everybody to do because of these conditions is, man, get off margin. If you're on margin, get off margin. Find your winners, sell them, get out. Like right now, I sold my banks. I had Wells Fargo and JP Morgan, and I had Visa. And so I sold all those, and I got a whole lot of money back for that. So now I'm sitting on a stack of cash, and I'm no longer on margin. The next thing is you have to expect a lot of volatility, and you have to expect that a lot of your stocks are actually going to go down. So they have to be your highest conviction stocks, stocks that when they go down, you don't think about selling them. You look at them and you go, you know what? I think I want to buy more of that. That's a really nice price. The last thing on your mind is selling what you have. So make sure you're in those kind of stocks. Whatever that stock is to you, then buy that one. Expect that values are going to compress. Expect that, say something like, an Apple, for instance, which traditionally trades between 15 and 20 PE, now trading at 30 PE, it might eventually come back down to like 20, 25 PE. You don't really know, but just expect some value compression. Expect these no earnings or very low earning type stocks, your high flyers like your cloud stocks, Datadog, Palo Alto Networks, Snowflake, CrowdStrike. The list goes on and on and on with these things that have no earnings but have just been taken off through the roof. Maybe it's time to just, sometimes you lose, okay? Take the loss and just put it into something else that isn't going to lose your money. And have cash on hand. Wait for these values to compress, and then when you see the opportunity, go ahead and jump on it. If you have a high conviction in a stock, like I do with the stocks that I'm going to bring up, you have cash on hand, and when you have cash on hand, you get like a lot of guts when it comes to letting your options roll, right? So you sell a cash secured put. And I have videos on that as well. But what that means is that basically that a cash secured put means that if a stock, rather than just putting a limit order on a stock, you're saying if a stock falls to this price, I'll buy it. And you take a premium or money from somebody else to actually buy that stock. And if you have a high conviction in that stock, you'll either A, buy the stock because it'll go down to a price that you love, or B, not buy the stock and take their money for holding that position. So selling cash secured puts is going to be a thing that I'm going to be doing a lot of here lately. So I'm off margin, plenty of cash, and I'm going to be selling cash secured puts. And what am I buying? Well, I'm going to be buying Microsoft. So Microsoft, why do I love Microsoft? So this is the reason why. It's unaffected by supply chains. So say what you will about supply chains and Omicron or what have you. Microsoft doesn't care about that. Everything is done, via the internet and downloads. It's unaffected by pay increases. We've all heard about this wage increase that's going on right now. Well, Microsoft is one of the highest paying companies on this planet. And if anybody says, you need to pay me more, Microsoft, they're like, good luck, we'll find somebody else that'll pay you more. They're not going to be really affected by this wage squeeze, like say like a Starbucks would, or a McDonald's, or just really a lot of retailers are going to be facing this problem. JP Morgan faced that today, is that their expenditures went up due to wage increases. So they're going to be unaffected by that sort of thing. They're not going to be affected by Omicron that much as far as like working from home is concerned. Microsoft developers can work from their living room if they feel like it. So Microsoft is one that seems to be sort of like insulated from a lot of the problems that we have right now. For that, Microsoft is my #1 pick for what I'm buying right now. Now, Microsoft has an elevated PE. It's sitting at about 38, normally runs at about 25. So it's got a little ways to go before it actually comes down to what I would consider to be a good traditional price. But it's still one that I think to at least start a position in and kind of buy it on the way down. It's not a falling knife. It's going to be a rubber ball. It's coming back because it does grow every year. Plus, they've got the Microsoft Azure. They've got we've all heard about Amazon Web Services, like their thing. But Microsoft has their own version of that, which is growing. And plus, they've got all their stuff has gone since Satya Nadella got there. They've turned all of their software into subscription based. It's got recurring revenue. What else they got? It's Microsoft. They're ubiquitous. They're all over the world. Every office has to have it. Every business has to have it. And there's pretty much no alternative. I don't even know if you don't have it. What else is there? So all those reasons, Microsoft is my pick. Nvidia is also unaffected by pay increases. There's people making an awful lot of money. And this is the irony of Nvidia. I've noticed that the supply chain problems has actually made their products, their GPUs and CPUs, actually go up in price. Like people will pay more for it because it's almost like a supply and demand. Like now they can't get it, and their stuff's actually benefiting somehow from supply bottlenecks. And plus, to me, they're the most innovative company in the world. If I had to pick one company that I was going to live and die with, it would be Nvidia, with their AI and their graphics cards, and the fact that they're like all into the Bitcoin mining or whatever, and they're also the autonomous driving type. Like they teamed up Luminar with LiDAR technology for autonomous driving. And to me, they're the most innovative company in the world. And they're my favorite company in the world. And I could pretty much run an entire portfolio just off of Nvidia alone, just selling puts and just buying the shares. But I will diversify a little bit. I do have Microsoft, I do have Nvidia. And then I also, Lowe's and Home Depot, I think that those two stocks seem like good ones to me because they are both still low in value. Lowe's having a better PE than Home Depot, but there's a duopoly there. They've cornered the market on housing, and even if you don't have your retailers going in there, your home repair type people, your DIY folks in there doing it. Still, big businesses are going in there buying loads off these guys and starting huge construction projects, and you're going to pretty much use one of the two, right? You might have your home builder like Lennar or Toll Brothers, but they got to get their stuff from somewhere. So they're sourcing their stuff from these guys. So you talk about a mighty duopoly. I would say it's Lowe's and Home Depot. And even if you lose money in the short term, you're going to get dividends and you'll get it back in the long term. And then the other ones I'm looking at keeping an eye on Adobe, because Adobe to me is like Microsoft. It's got all of the same, like things I like about Microsoft. It's just priced higher, but it has a better growth potential than Microsoft. So it's got a richer valuation, but bigger growth. So I like Adobe, but I go with Microsoft, but I can go with either one. I might end up buying both. Next, we already discussed that retailers, retailers are going to have a hard time unloading their product right now, whether you're Best Buy or your Foot Locker or Dick's Sporting Goods. You're going to have a harder time getting rid of your inventory. So what you're going to need is more advertising. And so advertising, I think, is going to come at a premium this year, and there's going to be a lot more advertising. And for those reasons, I do like Facebook and I do like Google for the coming year. And Facebook looks like they think there's not going to be that much growth. It looks like year over year for them, but I disagree. I think that advertising is gonna boost Facebook this year, and same thing for Google. So that is actually, so those are the things that I have going this year right now. So I'm basically buying the companies that I already stated there. If they go down, I don't care. I'm going to sell cash secured puts. And those are the reasons why I'm buying is because I think that there's just less money in the world right now. And so we're gonna have a bumpy road. Make sure that you have cash on hand. Make sure that you're not on margin. If you got anything out of this video, please like and subscribe and even hit that little notification bell. Until then, I'll go ahead and see you next time. Bye.